What's up, everybody? So we just created another millionaire in the academy. Super cool. I just had a call with Davey, and he's about to post this in the group that officially crossed over the mark. I'm really excited about that, and it's crazy to see this happen, guys. There's been so many of you that have become millionaires within this group. But remember, this is a testament to you, not even the academy. It's that you've committed to the process, and you realize that if I do the process, this thing works. And it was crazy. We actually mapped out his net worth increase over the last 6 months. And I'm like, man, you realize that's like an 8 year period. If you started with $0, zero net worth, you would become a millionaire in 8 years. He's like, man, that's crazy to think about. And the biggest thing is like when we talk about, my personal growth that we've had, I always explain it to people is it's not rocket science. And if you guys follow the roadmap to financial freedom, which we lay out in the academy, literally the title of my dang book, you're all going to do this stuff. And it's just so awesome to see every single day. And he said, man, this community fires me up. Elizabeth, big shout out to you. He brought you up individually. And he mentioned that your story is extremely inspiring. And it's really cool to see that. He said, man, I can't help but rally around her. Man, it's the community, the realness of the community and just how raw people are with sharing what's going on in their situation. And guys, this is what this whole thing is about. So I'm super fired up about that. With that being said, I want to walk through a lesson for you guys. So I think this is a really relevant time to talk about this. And let me tell you why. Is because the S&P 500 has been on a tear. Now, obviously, yesterday was a little slide, whatever. It's a day, right? We don't pay attention to day to day. But if you look at, man, the max over, you guys can see where we're at historically speaking. We have went from, in 2020, we were down at 2,500. It has raised 3,000 points since that point. So over a 4 year span, we have taken a significant growth over the past 86% in total return. So I have tons of S&P calculators you guys can check, based on whatever, but like we're rolling, and that's a good thing. It's also expected to some extent. But when there's times of euphoria, and it almost feels like people are forgetting that, hey, the market does drop from time to time. I want to remind you guys of a very important concept, right? It's really fun when we're building wealth. It's really fun when things are going smooth, the market's going green, and everybody's making money, right? You remember this time, right, in 2020, right here, from basically COVID on to 2021, everyone was like, man, you can't lose. Like, the only thing you can do is win. And then we had this slide back right here in 2022. I want everybody to remember this will happen, and that's okay. So we will take a slide. I don't know when it's going to be. I'm not going to predict the market. You guys know how I do. I don't predict the market. I don't know when it's going to happen. But at some point, naturally, it's going to happen. And I don't want people to freak out and panic sell when that time occurs. And so right now, when we're at market top, I want to talk about this because this is the time people need to be reminded the most is the market will slide eventually. It could go, we could hit 6,000 before we know it. And who knows, I don't know the trajectory, the timeline of any of this stuff. Nobody does. Ultimately, if somebody's telling you they do, they don't. They're lying to you. And I don't know what's going to happen in the near future, but what I will say is, even with meteoric rise, there'll be some drawback, and that's to be expected. And so again, coming down to the education context, everything, it's expected. We know it's coming, and so how do we prepare appropriately? I had this great resource. It's actually in week 8, so if you guys do want to pull it up, Portfolio Visualizer, it's optional, but I think this tool is so great. So we as investors have to think with a long-term mindset in place, but also we are human and we do have emotions, right? And so even when we automate this whole entire process, which we will all be doing, if you haven't already, we have to be aware that there will be a pullback and we are going to see our portfolio drop. Like if I see my portfolio go from, let's call it 2 to 1.5, and I lose $500,000, I don't actually lose $500,000. That is a temporary setback from a value-based perspective. So the amount of shares that I own when I'm purchasing every single week, I still own the same amount of shares. They're just worth less. And so there's a high probability with the way we invest here with low-cost index funds, ETFs, that if I'm buying the right stuff in line with the broad markets and stuff of that nature, and in line with my risk profile, in line with my goals and my timeline, everything we talk about from weeks 5 through 11, specifically this week 10 resource that if you haven't watched this week 10 resource and done this yet, I highly recommend to go do this. This is going to be a great kind of the end goal of weeks 5 through 11 to kind of piece it all together for you. But if you haven't aligned yourself and put yourself in a position, a portfolio that is the best for you, just because somebody else is telling you you should be doing X, Y, and Z, or you guys even see my weekly buys right here, and you guys are, well, I'll just go ahead and do whatever he's doing. Let me warn you, you might not be suited to do what I'm doing. I'm 100% equity, almost close to it. So if the stock market falls, my portfolio is going to fall. I'm aware of it. I'm very in tune with this. But from the average person out there that doesn't maybe know this, on Twitter or on Instagram, and they're just watching my stuff and they see this stuff and they go recklessly buy and they don't think about the repercussions or the potential risk factors of this type of buy, you got to be careful. You got to be careful. And I know you guys are on a whole nother level and wavelength of knowing and in tune with the stuff. But for those that are just joining, those that are new, or those that haven't gotten to weeks 5 to 11, remember, downturns happen. Downturns are normal, and I want to remind everybody about that. That if we get too euphoric, it could all of a sudden turn on us in a split second. So I want you guys to be protected. Now, this resource right here, Portfolio Visualizer, back testing overview. Now, there is no way we're ever going to be able to predict the future. But what we can do is look at the historicals and see how it's performed and what my level of risk is with my current portfolio. So you guys, I highly recommend to be using this. I think this is a very valuable tool. So you can basically edit your portfolio. You can edit whatever you want. I just have a classic core 4 portfolio here. Nothing crazy here, but it's a really good portfolio. So let me pull this back up so I can pull up week 8 specifically. So week 8 when I portfolio, that's the wrong video, sorry. Portfolio visualizer. So when I see this, what does this tell me? This shows me what my current this is not my current portfolio, just an example, right? So this is a current portfolio. What is the level of risk I'm willing to take on during this time frame? So obviously, depending on the type of ticker symbol you use, a lot of these haven't been around for that long, right? So like we only have results from 2015 to 2024. That does not tell me historical context of the truth. So if you guys are looking to see something that mirrors a type of fund like this, like you can go see the inception dates of each one of these. So you can do like VTI inception date right here, and you're going to find out it's 2001 right here. Inception date's important because while it's the total stock market, we're only testing and looking at from January 2015 to June 2024. And if we're looking at VTI from that standpoint over the last, let's say from 2020, or what date was it, 2001, or 2015. So 2015, it would be right here to here. Well, obviously, historically, it wouldn't be representative of the whole sample size, right? And so we want to make sure we know all the way back to the beginning, to June 1st, 2001, which is the inception date right here, as you can see on the screen. Not only that, that's a small time frame still, even 20 years. I want to see hundreds of years of data. So what I want to do is understand what the total stock market has done during that time. And all you have to do is find an equivalent ETF or index fund. And most of these haven't been around for that long, 20, 30, 40 years max. And so you want to be careful when the first index and ETF started coming. But we want to understand historical context as well. So if I'm trying to figure out, okay, I see this backtest portfolio shows me 2015, but what about 1924 to June 2024, 100 years of data. I can go look at the total stock market performance during that time frame and the level of risk that comes with. However, when you're looking at these specific ETFs and funds themselves as a sample portfolio, you can go down here and you can go see the actual returns during this time. But you can also see, which is I think more important right now, the level of risk you're willing to take on. Now, to give you guys context of standard deviation, that's the amount of volatility that's occurring. 15% is what the S&P historically is. So if it's below that, typically speaking, you have a lesser level of standard deviation. But this other number here is really, really important, is your drawdown. Because this is the number I want you guys to kind of focus on to a certain extent. And we do a lot of quizzes. We do a lot of education to get you to understand this piece. But if I were to have $1 million portfolio, now the dollar amount is very valuable here to assess, because if I have a $10 portfolio that drops 23%, it drops $2.36. Not that hurtful. It's $2.36. However, if I have a $1 million portfolio, am I willing to lose 23.6% temporarily? Am I willing to accept that volatility in my portfolio temporarily? There's no right or wrong. Remember that. There's no right or wrong. So if yes, this portfolio is totally, maybe you want to go more risky. Maybe you're like, well, I'm okay with 30% because I want to see this number at, 10%, or a little higher percentage. I want more upside, but I'm willing to take more downside. If you're okay with that, be my guest. As you build capital, you, from a numbers perspective, value perspective, you will naturally probably take on less risk. A lot of people do. Some people continue it. Like I'm cool with 100% equities. I don't care if it drops 30, 40, 50%. And I say that because I've actually lived it through 2020 and 2022 when we slid 20% backwards. I was cool with it. We slid 34% in COVID. So did not make any moves, did not have any bit of emotion towards that. I understood the long picture. I understand I'm not touching this for years to come. For those that are willing to take that risk, go for it, right? But make sure that you understand what that really means, because everyone says they can take on the risk until it actually happens, and all of a sudden people panic, right? And so this 23%, 23.6% number drawdown, that's the biggest drawdown it's had, this portfolio would have had during this time period, which is a short time period. But maybe if you extend that over 20, 30 years, this might be a 30%. Are you willing to take that drawdown, potential drawdown, to get the maximum upside? No right or wrong, guys. Here, this is definitely not a new information. It's just a reminder more so to think through this stuff. As you guys go through weeks 5 through 11, we do cover all of this, and especially that week 10 resource. If you haven't used it, I'm telling you right now, go do it. Make time to do this, because it will piece this all together and make sure that you're doing this the right way. But this is a very important concept. And so as you guys grow capital, start thinking about this. As people are euphoric, start thinking about this. It doesn't change my plans. I still want a dollar cost average into ETFs and index funds, but I want to make sure that mix is something I'm willing to stomach if something happens, even though I know it's temporary. And knowing your timeline, if I'm coming up on retirement, I'm probably not going to have something like this mix, because what if I lose my retirement as a result? You won't lose your retirement as a result if you have 10, 20, 30, 40 years ahead of you. But if you have 3 years ahead of you, this is not a portfolio that would be suitable for somebody like that, right? So that's why everybody's portfolio should be different depending on their goals, risks, timelines, their ages, all of that kind of stuff. The level of emotion that somebody has, it's very, very important stuff. Level of education that you have, all that kind of stuff. So anyways, wanted to send this video. Please go use this tool. Please remember that the market doesn't just go up. As much as I would love it to just go up, it doesn't. And you guys will all be richer as a result. The other thing to think about, last piece of advice here, is when the market does pull back, like I mentioned and explained in 2022 right here, this is when you get rich as well, because if you dollar cost average up, you're buying less, right? So if it costs me $250 to buy right here per share, and I have $500, I buy 2 shares, and then it gets, the higher it goes, well, now it's $300 a share right here. Now it's $400. Now it's $500 a share. Now I'm only buying 1 share with my $500 increment every single 2 weeks, right? That's okay. That's a good thing, because now when it pulls back, I'm buying more shares. I still have that $500 circulating into the market, but it's buying more or less shares depending on where the market is. And if I dollar cost average that, on the way up, I'm buying less theoretically. On the way down, I'm buying more shares. And so when on the way down, that's when you make a lot of money, because you're buying more shares. Now when it reverses in 2022 to 2023, now this is when you get very wealthy, because all those shares you bought at a cheaper price, now they're increasing in value all the way up to the top. That's when you get rich. And so remember this, guys. This is a very important concept. I want to make sure you're all protected and you're thinking, not necessarily protected in the sense of a downturn, but you know what's coming before it comes, and you're prepared for that moment. As long as you're prepared, you guys are going to get very wealthy. Just like Davey in the beginning, man, turning into a millionaire during the academy experience, amazing to see. And so many more of you guys have become millionaires. So let me know what you guys need. Any questions on this topic, please drop them down. This is a very good topic to talk about. And have a great day, guys. Have a great week. Go crush it, and continue to do what you guys are doing each and every day for you and your family. It's inspiring to see every one of you guys take action. Elizabeth, Davey, everybody else here, you guys are awesome.